From Silicon Valley to Signature Bank, exploring the 10 most devastating bank crashes in America. The recent bank failure has caused shockwaves throughout America's financial system. In a shocking turn of events, major U.S. banks have suffered staggering losses of over $206 billion, with each bank possessing more than $5 billion in assets. These assets have lost their value, causing a catastrophic bank run. Silicon Valley Bank, or SVB, one of the largest banks in the country, has made headlines as it was placed into receivership on March 10, 2023, marking the second biggest bank failure in American history. The shockwaves of this failure were felt across the nation, with many people unaware of how often bank failures occur. And if that wasn't enough, the closure of Signature Bank followed just 2 days later on March 12th. It's not the first time we've seen a surge in bank failures during tough economic times, with almost 200 banks closing during the housing crisis in 2009 and 2010. The question on everyone's mind now is, what's next? Bank failures have been a recurring issue in the United States, particularly during times of economic turmoil. From the first financial crisis in 1819 to the recent COVID-19 pandemic, numerous significant economic events have led to high rates of bank failures. Fortunately, obtaining adequate FDIC coverage for their funds has mitigated the risks of losses for individuals and businesses. Despite recent events such as the Great Recession and the COVID-19 pandemic, the country has a long history of economic panics resulting in bank collapses, and it is worthwhile to begin at the start. Before we start out, do subscribe to the YouTube channel and like the video. Number 1. American Savings and Loan. Founded in 1922 and headquartered in Stockton, California, American Savings and Loan was a savings and loan institution that specialized in providing consumer-focused products like personal mortgages. Unlike traditional banks that primarily work with larger commercial clients, savings and loan firms cater to individual consumers. Unfortunately, American Savings and Loan faced significant challenges in the 1980s, including a run on its deposits in 1984 that resulted in nearly $7 billion being withdrawn. The institution's substantial holdings of mortgage-backed securities offered little relief in an environment of volatile interest rates. Ultimately, American Savings and Loan failed in September of 1988, with assets totaling approximately $30.2 billion. Number 2. Continental Illinois National Bank and Trust. In May of 1984, Continental Illinois National Bank and Trust, which held assets of around $40 billion, experienced the most significant bank failure to date. Previously the 7th largest commercial bank in the United States based on deposits, the institution was forced to close its doors following a massive run on its deposits by concerned depositors who had become aware of financial instability. These depositors pulled out $10 billion within the first few days of May, ultimately leading to the bank's downfall. Number 3. First Republic Bank. On July 29, 1988, First Republic Bank Dallas, which held approximately $32.5 billion in assets, experienced a notable bank failure. This financial institution was the largest bank in the Southwest and had a significant market share, with 20% of all commercial bank loans in Texas. Unfortunately, First Republic Bank Dallas struggled to maintain its financial footing and manage its loans effectively, failing to keep pace with changes in the industry. Among other missteps, the bank neglected to update its appraisals, even as real estate values plummeted by 10 to 15% annually. Additionally, bank management used overly optimistic projections for rent, low vacancy rates, and low discount rates to present false cash flow projections, further contributing to the bank's collapse. Number 4. Bank of New England. The Bank of New England, once a flourishing financial institution, faced troubled times when the real estate market took a downturn. As the bank's portfolio contained a significant amount of construction and commercial mortgage loans, its balance sheet began to suffer. This was reflected in the fourth quarter of 1989, which showed a staggering loss of $1.23 billion. By the following year, delinquency rates on almost half of the bank's construction loans and 20% of its commercial mortgages had spiked, leading to the bank's failure on January 6, 1991. Number 5. IndyMac. IndyMac, which had assets of approximately $32 billion, emerged as a significant player in the banking industry during the early 2000s real estate boom by focusing on offering loans that required little in the way of income or asset verification from borrowers. This allowed the bank to thrive even if home prices rose because it could easily foreclose and recover its loan amount by reselling the property. However, when the real estate bubble burst and home prices plummeted, IndyMac's fortunes took a sharp turn for the worse. The bank was unable to manage its growing losses, resulting in its eventual failure on July 11, 2008. Number 6. Washington Mutual, 2008. In 2008, Washington Mutual Bank, which had around $307 billion in assets, experienced the biggest bank failure ever. Within 10 days, customers withdrew almost $17 billion in assets during the banking crisis. Although Washington Mutual didn't receive any financial assistance from the government, it was seized and sold to J.P. Morgan for $1.9 billion, preventing the FDIC from having to pay anything out of its reserve fund related to the bank's closure. Washington Mutual, also known as WAMU, was a large U.S. savings and loan bank that collapsed during the 2008 financial crisis. The bank had been heavily involved in the subprime mortgage market, which involved making loans to borrowers with poor credit histories. These loans were then packaged into complex financial instruments and sold to investors, often with little transparency or oversight. In September 2008, the bank was seized by regulators and sold to J.P. Morgan Chase for a fraction of its previous value. The collapse of WAMU was one of the largest bank failures in U.S. history, and it had a significant impact on the broader financial system. The event prompted greater regulatory oversight and implementation of stricter risk management practices in the financial industry of other banks. Number 7. Colonial Bank. Colonial Bank, which had started with just $166 million in assets in 1980, grew into a significant player in the banking industry, with over 350 branches and more than $25 billion in assets by the time of its collapse in August 2009. However, Colonial had become too heavily invested in the Florida real estate and construction markets, which proved to be its undoing. When many property owners defaulted on their loans, Colonial was unable to absorb the significant losses. Another significant factor in the bank's failure was the involvement of Catherine Kissick, a senior vice president who played a key role in a $2.9 billion fraud scheme that contributed to the bank's collapse. In 2011, Kissick pleaded guilty to charges related to the scheme and was sentenced to 8 years in prison. Other individuals involved in the scheme received shorter sentences. Number 8. Doral Bank, 2015. Doral Bank, a Puerto Rican bank, failed in 2015 due to risky lending practices, poor management, and fraudulent accounting. The bank's management was criticized for being ineffective and closely aligned with the former CEO, who was later implicated in the bank's collapse. The bank's collapse highlighted the importance of strong risk management practices and effective corporate governance. The bank's board of directors was accused of being too closely aligned with the former CEO, who was accused of engaging in fraudulent accounting practices. These practices had the effect of artificially inflating the bank's financial results and hiding the true extent of the bank's financial difficulties. The bank's collapse had a significant impact on the local economy, as many individuals and businesses had accounts or loans with the bank. Number 9. Signature Bank. On March 12, 2023, Signature Bank, which had assets of approximately $110 billion, was closed down by the New York State Department of Financial Services. This occurred only 2 days following the collapse of the Silicon Valley Bank, intensifying concerns about the stability of the banking sector. Government officials were quick to reassure depositors that their funds would be safeguarded, but unfortunately, shareholders and certain other unsecured debt holders would not receive the same protection. Number 10. Silicon Valley Bank. SVB was founded in 1983 and considered as the 16th largest bank and second largest bank in history. On March 10, 2023, Silicon Valley Bank, which had assets worth approximately $209 billion, was taken over due to a sudden rush of deposit withdrawals. The significant scale of this failure caused upheaval in financial markets, with widespread concern among depositors about the security of their funds. In response, President Joe Biden stepped in to provide reassurance that the safety of their deposits would be upheld. Who is responsible for this crisis? why is this happening? The primary reason for this colossal loss was the issuance of new bonds by the US government at high interest rates, which significantly decreased the value of bonds already purchased by the banks. Silicon Valley Bank took the biggest hit, losing a jaw-dropping $2 billion on a single bond, which it urgently needed to pay back its depositors. This caused panic among investors, who scrambled to get their investments back. The repercussions of this disastrous event rippled throughout the financial sector, with Citigroup losing $47 billion, Bank of America losing $21.2 billion, JP Morgan losing $17.3 billion, and Truist losing $13.6 billion. This event shook the very foundation of the American banking system and sparked a wave of fear and uncertainty among the public. These banks are under review for downgrading are Silvergate Bank, UMB, Zions Bank Corporation, Comensa, Western Alliance Bank Corporation, and Intruist Bank. While the exact causes of these losses were complex and multifaceted, they underscored the importance of effective risk management practices, transparency in financial transactions, and the need for sound financial regulation. As the financial industry continues to evolve and face new challenges, it is imperative that banks and regulators learn from these experiences and take steps to mitigate risks and prevent future crises. And that concludes our list of the top 10 craziest bank crashes in America that you should definitely check out. Let us know in the comments which one you thought was the most interesting, and don't forget to like and subscribe to our channel for more exciting content like this. Thanks for watching.